Yes. Okay. Welcome. I think we have a good turnout. Thank you all so much for joining us today on what I'm sure is a very busy day for everyone. We really appreciate your attention to the student debt issues and your time today in learning more about our proposal, the Equality in Higher Education Financing and Repayment Act. This act is, some of you know, may be sort of familiar with it already, but it's a comprehensive and long-term effort to sort of fairly and equitably tackle student loan debt that students, graduates, and parents are facing in just unsustainable levels right now. This debt we know is exacerbating problems in equality, in education access and opportunity. It's also inhibiting things like entrepreneurship. It's distorting economic behaviors and preventing our economy just in general from recovering from this pandemic-related recession. So the current student loan system consists of some pretty confusing financing and repayment programs that are in some ways inefficient and really ineffective. There's also some short-term, you may be hearing in the news, some short-term proposals out there. You may be familiar with the one that Biden has been proposing for forgiving $10,000 in debt, and Schumer and Warren even taking that a step further to $50,000 in debt. And while those may be very helpful in helping students and graduates with their debt, they're not really providing sort of a comprehensive long-term solution to the sort of underlying front-end issues in the student debt crisis. And that's what this legislation, exactly what this legislation is aiming to do. It's the product of over a year's work with a great team of looking into student debt issues, looking at a variety of solutions, and a lot of collaboration. And that team includes Angela Inzano, the Director of Advocacy and Engagement at the CBF, and Bob Glaves, the Executive Director. But really the heavy lifting and the expertise really coming out of our pro bono team, who I'd like to introduce to our panelists in that pro bono team. Erin Turley, who's a partner at McDermott, Will and Emery. David Whaley, partner at Thompson, Hine, and Allison Wilkerson, also at McDermott, Will and Emery. So those are our three panelists that we are very grateful to have today to talk to us a little bit more about some of the important tenets of the proposal and how these provisions are really can be a big part of the solution to student loan debt in the United States. Before they speak to you on that, I wanted to, and I'll try not to be super long-winded with facts and figures, but I do think it is important to just provide you with some numbers to kind of wrap our head around and frame the scope of the student debt crisis in the United States. On our next slide, I don't know, Angela, if you could pop over to the next slide. Americans owe 1.7 trillion in student debt nationally. It is now actually the second largest form of consumer debt after mortgages, and that's second to credit card debt. The average student loan balance is more than $35,000 when looking at all generations spanning from Gen X to boomers. Recently, the Education Department, with the help of two private consultants, looked at 1.37 trillion in student loans held by the government at the start of the year. And in that analysis, they found that borrowers will pay $935 billion in the principal and interest. So that would leave taxpayers on the hook for $435 billion, according to these documents and findings. So it's stats like this that really made the CBF start looking at this is a huge problem for our country. And we realized that we needed to broaden our lens for solutions outside of just the legal profession itself. I wanted to outline a couple key aspects of the problem. Tuition increases have far outpaced inflation. And so when looking at an undergraduate study, for example, a 1988 grad of Harvard would have spent about $17,000 on tuition during their senior year. Now, in their 50s, they'd have to pay almost $45,000 in tuition for their child to attend Harvard today. That makes the current cost more than 2.5 times as much as it was in 1988. And that would come out to be a markup of 163%. Those of us with planning for college, our kids for college right now, that's not a surprise, but it is nonetheless still a shock, I think. Another interesting finding was that over the last 15 years, debt held by bachelor's degree recipients has substantially increased at the national level. Now, while growth in average debt loads leveled off over recent years, average debt loads over that 15-year period grew by 56%. And for example, that would be over 18,000 in 2004 to almost 29,000 in 2019. And this is well outpacing inflation at 36%. This study also looked at law school specifically. Their inflation has been a factor in rising law school prices, but law school tuition increases still exceed the inflation rate between 1985 and 2019. In 1985, for example, the average private school tuition was about $7,500, which would have cost a student almost $18,000 in 2019. Instead, average tuition was almost $50,000 in 2019. So in other words, private law school was 2.76 times as expensive in 2019 as it was in 1985 after adjusting for inflation. So when the CBF would advocate for back-end forgiveness programs, which is a part of the proposal in DC, and we've had a long standing involvement in student loan forgiveness, we'd often this would be the biggest question that would come up: what's being done, not just at the back end, but what's being done at the front end to put the brakes on these increases? We wanted also to highlight two other problems, a couple of problems with the student debt loan system that go to equity in education, education access, and also in the larger economic impacts of the student debt crisis. So turning first to equity, Black graduates have more debt and are more likely to default on that debt than their white peers. And this really goes to furthering the wealth gap. The gap in student debt held by Black and white borrowers grows by 6.8 each year. As a result, Black young adults hold 10.4 less wealth on average than their white counterparts due to student debt. While older millennials with a bachelor's degree or more have a median net worth of over $60,000, their Black counterparts have a median net wealth of just $6,400. And it would follow that without resources like home equity and money or property inherited from previous generations and parents, Black families have less to draw from to pay for college and to pay off those student loans. The report also found that among students who graduated with a bachelor's degree in 2016, 40% of Black borrowers and 29% of Latino borrowers experienced difficulty making federal loan payments within 1 year after graduation, compared to just 22% and 19% of white and Asian borrowers, respectively. So we thought that was an interesting finding. Now turning towards the economy and the student debt crisis effect on the economy. Graduates are reporting putting off personal and economic opportunities like having kids, purchasing homes, starting a business, hiring a workforce to support that business because of their student loan debt. A survey in 2019 of college students planning to graduate in a year, 47% of those that were interested in entrepreneurship opportunities cited that student loans were the very greatest, the number one reason that they are deterred from starting these really important businesses after earning their degree, which we know is very important to our economy, these new businesses. And that is according to a Value Penguin study. We know also that COVID and the job market is only going to make these problems worse. That's sort of an obvious statement, but I wanted to point out one other study that kind of shows some of the economic impact of student debt. And that is a Arizona State University study, which found that 13% of all students have delayed graduation due to COVID, with low income students 55% likelier than their peers to have done so. Combined with the poor job market, we know coming out of this pandemic and coming out of this next year and next year possibly, this could really widen the gaps in postgraduate earnings and default rates between the low and the high income students. I wanted to turn towards some of the parameters and goals of the Act and get into some of the basic tenets of the Act. And I think Erin Turley will be kind of walking you through some of those parameters and goals. Erin, if you'd like to take over.
Happy to. And as Dawn mentioned, we were able to identify a number of the challenges that we see currently existing in the student debt program. And what we attempted in our collaboration with CBF was to truly come up with a holistic approach. Understand and applaud the efforts to get some sort of debt forgiveness through, but that is a one-time solution to a chronic and continuing problem. So what we looked at is some of the things that we see as challenges to reforming the system or creating a more efficient and accountable system. One of those parameters was the fact that student loans generally not dischargeable in bankruptcy. Another challenge that we identified is that the programs as they currently exist aren't allowing for a refinancing or consolidation of student loans across the board that can take advantage of the interest rates that we're currently seeing. And that would be a huge plus to most borrowers. Secondly, we've also noted, and this was really the supply-demand discussion, that part of the reason that we have significant increase in student debt, twice or three times the level of inflation, is because we have increasing tuition costs. And it is our belief that those tuition costs are specifically geared to the accessibility of those student debt and the federally guaranteed backing of that debt. So institutions can continue to increase their tuition rates because as they increase their tuition rates, the need is evidenced and they can access more money, the students, to pay for that. So we try to approach a holistic approach. Next slide. So with that, we wanted to do a couple of things. We wanted to put some measures into the Act that definitely assist with payment, and we'll go into those, but basically streamlining and simplifying the program in general. There's a multitude of programs, different payment options, different parameters along that. So we really did want to simplify to make it easier. We wanted to improve the education of borrowers so that they really understood what that debt in school looks like 5 years out when they're trying to repay it, so that they can understand how that debt will impact their plans to start their own business and better plan for it. We wanted to increase accountability, and this really goes to the institutions involved in this whole problem, and wanting to hold the institutions somewhat accountable for both the repayment as well as the successful placement of their students. And lastly, we really wanted to focus on long-term solutions, something that will fix the system going forward and into future years, as opposed to simply forgiving debt right at this point in time. So those were our goals and parameters. With that, I think next up is David to address some of the modifications that we're proposing.
Yeah, if we can go to the next slide. And I think it's important as we begin to talk through some of the modifications, there were some factors inside the statistics that really drive at the way in which we viewed, and the conversations with the CBF, the programs could and should work forward. The biggest factors with respect to those are that while we have a significant amount of student loan debt that does exist, about $36,000, $37,000 on average, the median amount of loans for a person is about $17,000. And so we see a pretty big skewing between median and average debt. Secondarily, you end up seeing a significant increase in the amount of debt that is applied for a person that's in graduate or a doctoral program, going to about $85,000, $86,000, I believe, for just graduate level only, above $100,000 on average for a person at a doctorate level. The programs that exist today have not taken as much account for the differentiation between the rationale and reasons behind why debt was incurred. And we wanted to begin to get to that understanding. And so when you see the middle of this slide talk about the ability of expanded forgiveness, we really do make a modification or an accounting for a spread between graduate and undergrad. Secondarily, there's a question pertaining to private loans. And very important to understand when we're saying private, we mean non-federally backed loans. About 1.7 trillion of the debt, there's about $1.7 trillion in debt in the country for student loans, as we discussed. About 1.6 trillion of that is federally backed. So you're talking about $100 billion, while a large number, a very modest amount of dollars when compared to the whole of the amount of student loan debt. And so we did want to account for the reality that private loans are a larger dollar amount often on average, but are not a significant portion of the total amount of student loan debt. Finally, and I think this is really important, one of the ways in which you have to look and understand that student loan debt is this spreading between that $17,000 median versus the $36,000, $37,000 average of student loan debt. It's been proposed that, and again, we did not spend time or talk as much about the cancellation of student loan debt, but there's been a lot of conversation about a $10,000 one-time cancellation of student debt. And I think it's really important to understand that if $10,000 of existing student loan debt was canceled, it would, all outstanding loans for 16 million people would be erased. So you literally get rid of 16 million people from the pool. It reduces the student loan balance on average by about 50% for the crowd of that crowd of people, and for about 70% of borrowers. You're talking about a large crowd of people that have a balance and a smaller crowd of people that have a very large balance. And when we put together this plan, we wanted to make sure that we had programs that were designed around attacking not only the large crowd of individuals that have a balance, but also attacking and dealing with the smaller crowd of people that have a very large balance. So the first thing with respect to that is, if you saw on the slide before, we're at historic interest rates that are significantly lower than what you would say has been on average. But truth be told, they've been this way since, 2008. And so we've had historic low interest rates for the mass majority of the past generation. And the inability of student loans to be able to tap into that extremely low rate to lock in what their future looks like has been a challenge with respect to student loans generally. And so there's two parts inside of this, the modifications we talk about, that really attack and utilize the lower interest rates. First, there's consolidation of private loans into the federal system. And we really do push for the ability of the private loans to be able to move into the federal system after an individual is outside of the schooling system, when they are at the end of their time of taking loans, so that they can access that lower interest rate. Secondarily, the proposed legislation actually does cap interest rates at a market rate not to exceed essentially 5%. And so while these are some level arbitrary numbers, what you're really doing is beginning to look at true market rates for, and this is important, for still non-dischargeable debt. Because the one factor inside of this that we did not think was correct to attack, we'll say, was the inability to discharge student loans in bankruptcy. The ease of ability to discharge student loans in bankruptcy actually does lead to a moral hazard of an individual incurring a great deal of loans with the anticipation to be able to discharge those in bankruptcy. So instead of actually creating a tool in which bankruptcy was the solution to discharge debt, we decided to go towards a place, and I think you see this in a lot of proposals, of expanded forgiveness. And the desire with respect to expanded forgiveness does break apart on the differentiation between undergrad and graduate, and private. And we really wanted to make it into a spot of trying to figure out, how do you put that forward in a way that is much easier than dealing with the alphabet soup of loan forgiveness programs that exist today. And what we came to is that we thought that right now it's generally 20 or 25 years, depending on the non-public interest student loan forgiveness based on income repayment. And the thought was that if you have a mass of loans that are $17,000 or median, a 10-year window for forgiveness seems to be a much more reasonable amount. And judging from the market, we looked at a 10% of free cash flows, essentially, of excess income, and that being 10% of income above 150% of the federal poverty line. Now, I will be the first to admit that 150% of the federal poverty line is a heinously low number with respect to individuals, especially single individuals. While there is some geographic modification to it, it's generally $19,500. And so you're talking about 10% of income for a single individual just getting out of school above $19,500. But just to give an idea of what that looks like, and I think this is important, if you take an individual that has an average student loan balance, not the median, that average, that $36,000 balance, and amortize their loan over 10 years, it's about a $400 a month payment. It ends up being $396 and change, I believe. That means that that individual would have to make over $67,000 a year before that $400 a month was less than 10% of their income. Thus, a person making less, and a single individual making less than $67,000 a year would be moderated on their loan repayment. They would have a governor with respect to what their loan repayment. And if they make that loan repayment on time, even the smaller amount, all the way to and through 120 payments, the remainder of the loan's forgiven. So you're giving a tool and an ability to a reasonable amount of income to be able to allow for individuals to repay their student loans and have moderation and a set timeline of knowing 10 years after I'm out of school, I'm done. Now, we raised that amount to 15 years for undergraduate and graduate combined. The thought being, again, we have this much, much larger pool of money that is going to graduate doctoral programs. Again, 15 years was a conversation. There are, with respect to the stats, it may very well be that a 20-year window is a much more logical window because graduate debt tends to be about twice as much on average as just undergrad debt. But the concern is that we have a 20/25 year model currently, and it's created real challenges in the system. And so moving down to a 15-year repayment system, you end up seeing what we need to do and how to be, that we can actually move people off of this. Finally, consolidated private, you end up seeing going to a 20-year window because you end up having a little bit larger balances. Finally, and I think this is important, you end up seeing public service not being necessarily just a 10-year window, but instead half the time of what the forgiveness would otherwise be. Thus, individuals that have public service work would end up having half as much time.
And
Next
David,
yeah.
just to chime in, sorry to interrupt, but we have also in the proposed legislation expanded the definition of what qualifies as public service and have specifically expanded that for doctors who are serving underserved communities and or workers, community workers, healthcare workers, et cetera, who are responding to the healthcare pandemic and that will be in the zone of tracking and tracing, all of the things that we've been talking about coming out of this pandemic and getting on top of it.
Sure. We go to the next slide. Yeah, and then the secondary part is we can't solve this, and colleges keep increasing in price. And so the anticipation is to provide a program that basically says, if you're a school who has too much on average forgiven at the end of 10, 15, 20 years, we're going to limit how much money can be provided under the federal system or the consolidation system to you as a school. So we finally get that inhibitor, that rein of pulling back the ever increasing price in tuition based upon their inability to access student loan money on a federal basis. Now, a lot of this portion is left to the secretary to flesh out, but we felt it was very necessary to have an inhibitor on the schools to continue the precipitous increase in tuition.
And just to add a little bit more color there, we also tie in both graduation rates, 75% or greater graduation rate, as well as total debt incurred versus their compensation coming out of school to those school parameters. So the school is on the hook not only to make sure that the students don't overborrow, but also help with placement and making sure they get jobs that can help them repay that debt.
I think we're to the next slide, and I think it's actually going to Allison.
Thanks, David. So after looking at how we might be able to consolidate loans or give people tools to sort of handle their student loan obligation, one of the things that I think we've seen arise in the last few years is how can employers also contribute to loan payments? And so what might possibly be low-hanging fruit with respect to getting more dollars into the system? That's not just coming from after-tax paychecks as individuals start to weigh whether or not to pay rent, food, student loan, things, etc. And a couple of things here is, first of all, when you ask 3 ERISA nerds to draft legislation, the first thing they're going to look to is how can you use what is already a system that has been built out and simply maybe direct those payments in a different way. And so a lot of the employer loan repayment assistance comes from that mindset. And part of this, quite candidly, is this is already items that we're seeing either as part of the most recent CARES Act, which was then expanded under the Appropriations Act, or quite candidly, private letter rulings as employers seek to provide mechanisms to their employees to encourage not only student loan payments, but not having to make certain decisions as to left hand, right hand with respect to their upcoming retirement benefits. And what I mean by that is actually starting with bullet 3 here. So McDermott participated in a private letter ruling that had one of our large employers going to the service and saying, look, we wish to encourage and incentivize employees to both handle their student loan obligation, but not put them so behind the 8 ball with respect to their retirement assets. Because as we pull populations with debt and people are making decisions with respect to put dollars, retirement comes really low on the list when you're weighing what your obligations are, especially coming straight out of school. And so what the private letter ruling sought to do was essentially treat payments made by the employee to student loan obligations as essentially retirement benefits that could then be matched. And so while those dollars weren't going into a retirement plan from the employer was allowed to make matching contributions. This one encouraged employees to make contributions towards their student debt payment, but also allowed them to start building up what is becoming a very important retirement system, or retirement backstop for that employee. So what we've done is codified that private letter ruling into a bit more formal process, and then added those parameters that ERISA nerds care about. So one of the things left off in the private letter ruling was, for example, how do you deal with discrimination testing, et cetera, not of which I'm going to build greatly here. But what we did was really look to treating amounts paid towards student loans essentially as salary deferrals. So when you think of your 401k amounts, instead of paying it to a 401k plan, we're instead paying it to our student loan obligation. Then the matching contribution is coming in and using that dollar to run through the matching formula. So if you're matching 3%, if you're matching 5%, that treats the student loan payment just as if it did that. Track that then through the various plan requirements so that some of the questions left open by the private letter ruling is how do we ensure that we're appropriately balancing our equities within that plan are addressed. We also opened up that system to other rooms, so simple retirement plans as well as government systems. So this is an easy way to allow employers to not only encourage those student debt payments through that system, but also allow people to continue to build up their retirement. So then kind of revisiting the top, the tax-free direct employer payments on behalf of employees for student loans. We already have this system thanks to the CARES Act, quite candidly, that was originally done for 2020. I believe the Appropriations Act actually pushed this out through 2025, which means that employers can pay on behalf of employees certain qualified expenses. Our proposal here pulls from the CARES Act and expands that to not only education being sought while an employee with that employer, but also debt taken in as part of that employee's process. And so payments made with respect to that up to certain limits becomes not includable in gross income of the individual. And so essentially up to $5,000 a year can be paid on behalf of that employee without an employee going, great, now I have this phantom income tax issue, i.e. that amount would, if included in my income, creates a taxable hit at some point, which could become problematic. So this allows employers to directly pay on behalf of those employees up to a certain amount on a tax favorable basis. Similarly, the Section 125 cafeteria plan structure does something similar. And I will say that we have not, as David said, with respect to as we set dollar amounts for forgiveness, et cetera, we haven't negotiated all of the dollars with respect to that. So limits, how this works, et cetera, is still somewhat open to discussion. But I think the structure here is, again, what we kind of consider low-hanging fruit. 125 cafeteria plan, and I think David's actually said this better than I've heard others, which is essentially if you're participating in this plan for your employer, the decision is current cash or a benefit. And so one of the easiest way to think about this is in the construct of a medical plan. For example, if I'm participating in my employer's plan, I have under my cafeteria offering of benefits elected that instead of getting current cash to the tune of $100 a month, I am instead paying $100 a month toward my employer plan medical benefits. Obviously a very cheap medical benefits for our world, right? So long story short is instead of being a medical benefit, they could make the same election, but with respect to student debt. And so instead of paying $100 to me currently, I would be paying that amount towards the towards my student loan payment. The advantage there is, of course, cafeteria plans have those amounts coming out pre-tax. And so I am paying amounts that will not then fall to my bottom line and be taxable income to me. So again, a tax favor mechanism of getting money to that student debt obligation.
And the goal here, sorry to jump in, Allison, but the goal here was really to bring another party into the solution. So we've talked about curbing the continuing increase in student debt and continuing increase in tuition. This is really to open up another avenue to give students access to funds that they don't currently have, absent the CARES Act and the Abbott PLR, to help with that repayment. And employers and employees alike are requesting this type of relief.
Not only that, it's also important that all of these are tax-free. So it allows an employee, a student loan recipient to actually be able to meet that 10% obligation on functionally a cheaper basis.
And quite candidly, between tax-free, oftentimes this will also be employment tax-free. So it does become a little bit cheaper to the employer as they're not paying that FICA or FUTA hit with respect to these amounts. So there is some employer benefit here. What the three of us have seen as we advise our employers are, one, employers are starting to compete for talent on benefit basis. And so how can we make that more attractive? And so providing a mechanism that makes for effective student loan policy, I think makes sense. The other is they are seeing their employees stressed, the people making decisions to go places because they do get an extra $1 an hour, because that does go to their student loan obligation. And so by taking off some of that stress, employers feel that they can keep the talent that they are seeking as employees versus losing people as they start to balance those, competing needs for cash. And so the final one, again, is going to penalty-free retirement plan distributions, i.e. if you've got essentially a savings account, for lack of a better term, in your 401k plan, why should you be in trouble falling behind on student loans if you have access to that money? When we're talking about relatively young individuals, anything paid out before 59.5 obviously has a 10% additional penalty besides being taxable. And so what we're looking at here is not only eliminating that 59%, but quite candidly making those amounts not taxable. So obviously all of these probably come with limits. Doing sort of huge amounts under each of these starts to mess up tax equities. But with respect to certain limits, this should be something that can be impacted relatively easily by the employer without costing significant dollars from the employer to be contributed to that, but providing a pretty significant benefit to individuals. Next slide. And the other thing that we talked about, and I know, liking it to what I've done more recently, which is a mortgage, you get information when you take out a loan. And I think one of the things that we started talking about, and a lot of this was really with respect to the for-profit institutions, where we see a lot of tension between the debt being incurred versus the benefit being received for those degrees, is really making sure that people understand what this debt means. And this is especially true when you have 17-year-olds, 18-year-olds taking on this debt with respect to this. And so we really wanted to look to developing a module. Again, this has not been fully built out, so what goes into this module makes sense. But some of the things that we talked about in somewhat encouraging colleges not to just continue to run up cost. The easier you make it to pay off debt, does it in their head make it, well, we can make it more expensive because we can now charge more because that debt can be alleviated better. So really making them explain to students what the cost of this debt is. And so some of the things we thought going into that would be not only the cost of attendance, because I think those dollars are relatively captured, and I believe we already have some mechanism for that with respect to student debt, but also things such as truly matriculation rates. What percentage of people actually graduate with a degree from the school? What is the median income of graduates 6 to 12 years after various types of degrees throughout the school? The median loan amount, job placement probability, and other financial aid options. We think that it becomes a much clearer story for individuals as they look to take on debt when they understand whether or not that debt at that particular institution, if there might be cheaper alternatives, depending on what they want to do with that, depending on whether or not they want to go into a more service-related role, which may not have the same equivalent dollars related to it. Does it make sense to go to that institution at that level? Or, for example, does it make it sense to go to a community college for the first year, get 4 classes out of the way before going to another educational system that would allow them to better plan for and use their dollars? And so as we draw home kind of what your life looks like at the end of that 4 years versus just a dollar amount, it hopefully will provide people into a little bit more insight on not only what dollars are they taking out, but what those dollars will translate into as far as truly repayable debt. So a lot of this goes to, and we sort of started here, but borrower education, so that it is not just a scary number. I mean, I know kind of when I was going through school, everybody sort of assumed they got out with some number that included a comma. I think translating that into when that gets paid off and how that looks, depending on institution, where they're looking to go to work, be it East Coast, West Coast versus middle of the country, and what that employment prospect would be, will really help them understand where their dollars are going to be coming from post-education. I think the next slide.
I think we go back to Dawn now.
Dawn, you may be on mute. The bugaboo of Zoom, right?
Thank you. Yeah, I think actually, thank you all. Thank you, Allison, David, and Erin, for those really great explanations on some of the key provisions, some of which are very complex to lay people, but that really helped clarify a lot of things. I think we touched on, through all 3 of your presentations, sort of what would be the predicted impact of passing these reforms. One thing that I was hoping, just open up to any of you, if you could just talk a little bit more about how these reforms would encourage economic stimulus and entrepreneurship in a time, during this pandemic and coming out of this pandemic, that we need it the most. Allison, you did a great job explaining the employer assistant components and some of the other ones, but I don't know if anyone would like to comment a little further about how these reforms would encourage economic stimulus.
Sure, and I'm happy to take a stab, and then I know David has thoughts as well. With the structure, the student has a definitive time period over which that loan is repaid, and then if they meet the payments, as David noted, then forgiven. And so that gives them an actual time horizon and payments that they know they arguably or hopefully can make, after which they can then do some planning. So 10 years, undergrad, once I complete this 10 years, if I pay it on time, anything left over is forgiven. That gives me a finite period to kind of figure out when I can go into that entrepreneurship or start my own business. By them pulling in the employers, we accelerate that repayment plan, hopefully, and maybe even completely repay it within a much shorter time period. And that encourages that employee who was previously working for large public corporation number one to go, you know what, I think I can build a better mousetrap here, and has the ability to go out and do something on their own and start that engine of American capitalism, which is a small business.
I also think that you get to a situation where you have a more educated consumer as you give information away, right? I mean, as we educate people, I know I have, as my friends have kids going to school, you know, more and more going to community colleges or something for that first year, because it is a cheaper alternative before they start building. And so a more educated consumer sort of helps with this. And then again, as the conversations amongst the three of us, when you look at those employer dollars, the way it works is if you're looking at that sort of 10% of pay going in, you somewhat almost have to include any amounts coming from the employer, any amounts coming from those other systems, such that you get to that 10%. Otherwise, the employer doesn't have any real incentive to add to that. I mean, if the employees already has to kick in 10% of their pay, adding dollars on top of that doesn't get you really anywhere or pull anything in. And so if employers are taking that 10% cap down to 3, 4%, you by definition have more dollars being used in other places than individuals simply sending it to the student loan federal loan process.
I think one of the other things we didn't get a chance to talk to as much, and I think it's important, is that if we do create a system that actually does penalize universities with respect to individuals who have a greater amount of forgiveness, because at the end of their 10, 15, 20-year window, they don't satisfy their student loan obligation, you're going to see universities start to get pretty interested with respect to why people are not meeting. And they may very well find out that there are certain majors, certain degrees that are being provided in which individuals end up not meeting that obligation. And they may, at that point, really have a conversation about repricing their education. We've talked about this a lot, and I think it's very important. It's a silly world in which your tuition for your 400 level classes and your 100 level classes is the same. It does not necessarily make sense. And that's what leads people to this thought of, is there a way in which community college can play a beginning role? I'll even take that a step further. Is there a way that traditional universities can begin to variable rate their tuition such that their 100 and 200 level classes are cheaper than what their 300 and 400 level classes are? And I will even go further to say, is there a way in which an engineering degree may end up costing more tuition than a social science degree? Because we really are getting the utilities of what that degree is worth in the estimation of economic benefits incurred in the 10 to 15 years following graduation.
Thanks, David. And Erin, that was really helpful. You know, another point that I just kind of wanted to, I guess, maybe in review that I think David and Allison and Erin, you touched on at different points, is how this proposal compares with some of the others floating around, including sort of the wholesale forgiveness of certain amounts that, you know, we're hearing Biden talk about, and Warren and Schumer, and also, you know, I think there's been in the news some ideas of expanded bankruptcy provisions, which I know you mentioned also briefly, but how, since we will be hearing about in this new administration and the new Congress, some student debt proposals, now that it is kind of a priority issue, how do we want to distinguish this proposal from others that are floating around, the cancellation of debt, or bankruptcy ideas in bankruptcy? What are kind of, I guess, sort of in review, sort of the hallmarks of this legislation?
Well, and I'll steal David's thunder because this was his comment throughout this process, is if we just deal with the back end, we're never going to fix the problem. And so we're going to continue every however many years, we're going to continue to find ourselves back in this student debt crisis because we're going to continue to have increasing tuition and lack of accountability. And that is the primary driver, or the primary differentiator in my mind, is the fact that we have tried to craft an accountability metric that will address the supply side, as well as draft in provisions that address the once incurred side of the debt obligation.
Yeah, and in comparison to the other opportunities that are out there, I think the biggest we end up seeing is actually Biden's plan, and it has a 20-year timeline at a 5% of free income, free cash flow rate, essentially. So it's about this. It's a longer time frame, a lower percentage. The estimate, the oddity, or with respect to bankruptcy, is there's not necessarily been a provision that said, or a true proposal that removes the dischargeability of student loans from bankruptcy. Instead, it's actually a repeal of the 2003, I want to say, act that actually made bankruptcy an never alternative to student debt. Before that, there had to be a pretty significant disability. So it's not as if before 2003, student loan debt was just freely dischargeable. It became out and out impossible after that act. It was not freely dischargeable before. It's a question about whether or not that line exists. You're still going to end up having a place that bankruptcy is not going to be a tool to discharge student debt, because if it were an easy tool to discharge student debt, it becomes the primary focus, leading to a moral hazard with respect to bankruptcy of being the means in which you get your debt forgiven. Instead, the bigger theory is, how do you get a program, a Biden proposal, to be able to drive forward? I think the biggest factor of this one is it really segregates out graduate student loan debt for forgiveness. Oddly enough, the Biden proposal does not include graduate student loan debt. As we see from the numbers, graduate student loan debt is a mass of that $1.7 trillion. A median of $17,000, an average of 36, and an average for people with graduate at 80 some, an average of people with PhDs over 100. The mass of that 1.7 is actually graduate. So a undergraduate only solution is not actually a solution to this problem.
Okay, thank you, David. We just got a great question on chat from one of our attendees. Sorry, I just lost it. If I could, if any of you want to field this question is from Colsom and Meji. How does this play out for going to the equity question? How does this play out for colleges which primarily serve low-income students? Many low-income students can't afford to attend other schools, and the broader realities of poverty, family income status, crisis requiring financial attention, and job eligibility will shape placement outcomes. I'm also curious about your analysis around bankruptcy as a moral hazard. I guess let's first take that first question. How does this play out for colleges which primarily serve low-income students? Many low-income students can't afford to attend other schools.
And I'll take a stab at that. I view the proposed legislation as being somewhat agnostic. So understand that there may be issues with placement rates in lower income schools and higher income schools. But given the way that we've structured the institution responsibility, it's not a solo endeavor. In other words, it's not solely the individual's responsibility to ensure that those metrics are met, and the institution becomes a monitor of that as well. And so I think that helps bring the institution into the discussion of, let's talk about what you can use this degree for, what some placement opportunities are, and really making sure that the right degrees are being sought and the right job opportunities are being identified.
Yeah, I'll take the question pertaining to the bankruptcy. I mean, the challenge ends up being is that if student loan debt is dischargeable in bankruptcy, you end up in a place where individuals, much like we see inside of a Medicare game, purposefully file as soon as they get out of college with respect to solely their student loan debt to forgive themselves from that debt. And you would purposely end up having no assets at the end at 22 or 25 or 27 years old to be able to discharge that debt, to be able to move into the marketplace with free and clear of the debt. If that is our tool, we're talking about functional free college anyway, and only for those people that are willing to spend down or remove enough assets to be able to file for bankruptcy to accomplish that. That's not an answer to our problem. Our problem has to be trying to quell the increase in tuition so as did not drive a need for larger loans. And if we end up quelling the increase in tuition so as to not drive a need for larger loans, and we offer loans to everybody, so that ends up being agnostic with respect to where you are on a wealth spectrum, the opportunities to everybody to get to be able to accomplish the American dream of going to school are available. On top of which, you as an 18-year-old that signed that note to be able to, God forbid, you go to an Ivy League school and are able to, you know that at the worst case scenario, if it's undergrad only, in 10 years, I'm clear. And that's a fantastic place to be able to sit as a lower income individual in the middle of a middle American city. If I can get in, I know I'm out in 10. It's worth taking whatever debt humanly possible to get that degree. Now, all of a sudden, the Ivy League school cares about how you do in those 10 coming out. Maybe they do. Maybe they have endowments that are large enough they don't care. But hey, another schools will very well care about how well you do in the 10 years coming out to see that your debt's not forgiven, to see that you have a job that, in my example, after it pays on average during the 10 years following $67,140.
And the 10% cap on free cash flow for the individual also serves as a solution to that issue, because regardless of how much you're making coming out of school, that 10% is set for everyone. It's, again, agnostic as to where you're going to work. It's tied specifically to what you are actually making in your profession.
Okay, we have one more question before I think we'll wrap up. One more question was offered in the chat on this topic of bankruptcy as well. Prior to the bankruptcy legislation, was it stated that bankruptcy was an option?
I'm pulling from memory, and this was during times of law school, so I apologize for this. But bankruptcy was not a wholesale option to the dischargeability of student debt. It became significantly more challenging after the Bankruptcy Act. It was a potential option. People had to, and I'm again coming from memory, there was a level of disability and inability to be able to discharge, to be able to, beyond just merely filing bankruptcy that was necessary to get that discharged. That became much more narrow under the act. And essentially you have to be and again, I know there are examples otherwise, but essentially you have to be Social Security disabled, is my understanding, to discharge student loan debt in bankruptcy at this point. There was a broader availability. It was not uniform availability prior to the Bankruptcy Act.
Okay, thanks for that, David. All right, well, I think we just have a couple minutes left. So in conclusion, I just want to thank our panelists so much for all of your work, your tireless work on this, and for not just taking the time today to give us a great explanation of the tenets of the proposal and the overall goals and impacts, but your work all year long on this. We are so grateful, and I'm so excited that we have an actual piece of written legislation to provide to our legislative champions on student debt going into this new year. So Erin, David, Allison, thank you so much. I also want to give a thank you to our intern at CBF, Brian Russo, who has also worked very hard on this issue and putting together the presentation. Angela would like to remind you all that on the Zoom group chat, if you'd like CLE credit, you can fill out the form there. And we will also be providing you with other communications from the chat, and also a recording of this. We'll send that to you later this week. And also just want to thank everyone for joining us, taking the time out of their day. I'm really excited what this proposal can do for our student debt crisis and helping students and our economy. So thank you for your continued support. Feel free to reach out to me, Bob, Angela or any of the panelists at any time. Thanks so much, guys.
Thanks.
Thank you.